Now we get to talk about Chapter 11. And for the most part, this is my last chapter I don't like talking about of the semester. 10 and 11 aren't my favorite chapters to talk about. Mainly because they're just chapters that aren't necessarily chapters that we see on a regular basis when you're doing a typical 1040, when you and I are doing normal taxes. It doesn't mean you do not see them, and I like to caveat that. It doesn't mean you don't see them. It's just a typical tax return, the ones that on a regular basis. But there's several things we're going to talk about in here that you will encounter. All right, there's several things that you will encounter. It's just not as frequent. All right, so when we're looking at property, there's a couple different learning objectives we're going to have. And the three different types of property we're going to talk about are Section 1231, 1245, and 1250. Now, 1250 we don't do quite as much with as 1231 and 1245. And then there's something at the end we're going to talk about that's called netting, but we're actually going to come back to it when we talk about Chapter 7. Remember how we skipped chapters? We talked about Chapter 7 and then look back. So that's we'll talk a little bit more about that, and we'll kind of circle back to it. Oh, I forgot. That's not in there. Let's see if this works. I don't know if that's going to work out. Oh, it does, yeah. Okay, so a couple things we got to think about. The amount realized. Remember, the amount realized is going to be the amount the taxpayer gets from the sale. Now, it's the amount we get from the sale minus anything that the seller has from the cost of the sale. So it can be the sales cost, but the other thing we're going to talk about is going to be, if you look, it's the cash received plus the fair market value minus any assumption, or plus any assumption of liabilities minus the seller's costs. So when we talk about assumption of liabilities, when we're talking about business and we're talking about buying of assets, and that's what we're really talking about for most of our Section 1231, 1245, and 1250, not all, but most of the assets, we could assume the liabilities that come with those assets. Meaning we buy it for $10,000 and we take on $5,000 of debt. So it's not a $10,000 asset, it's a $15,000 asset because we just assumed $5,000 of debt. That's what we're talking about when we say if we received any cash, the fair market value 10,000 plus any assumption of debt. So the amount realized is going to be that amount of money. So when we look at the assumption adjusted basis, another thing we got to look at is when we look at gifts. Right? The gifts, we got to look at, okay, what is the fair market value at the date that we got it, and is it greater than the adjusted basis of the donees? Okay, so if the donees basis is less than the fair market value at the date, then we will use that basis, the fair market value. So if at the date of the gift the fair market value is greater than the donees basis, then the donees basis is going to be what we choose. But if the fair market value is less than the donees basis, so that means the value is worth less than what we thought the donees was, then we're going to use what's called the carryover basis. And if the asset is sold at a later date at a loss, then we can use the fair market value. So actually, you're going to be able to use two different things depending on when you sell it. All right, so the donee uses the carryover basis if the asset is sold at a later date for a gain. So we're going to use the higher one if it's sold at a gain. That way it's benefiting us. And if it's sold at a loss, we're going to use the fair market value. So it's actually done for our benefit. That make sense? Said, you looked at me funny. Okay. Now, inherited property, I've actually mentioned this before. Inherited property is done at fair market value, or you have the option of what's called the alternate valuation date, which is 6 months after the date of death. So either the fair market value at the date of death or 6 months after the date of death. And I have seen where people, especially the stock market, have used the fair market value 6 months after. So if you think about when you inherit something like stock, we inherit property. You're going to get, your basis is now going to be the fair market value when you get this. Now, you don't pay tax on inherited items. So if you inherit land that's worth $100,000, the fair market value, that means you don't pay tax on $100,000. If you go to sell that land and you sell it for $120,000, you pay tax on $20,000. So if 6 months after your grandpa dies, that land's worth $110,000, you would prefer to take the fair market value as the valuation, the alternate valuation date, because now it's worth more. You're going to want to take what's ever higher because it's going to help you when you go to sell it, to shrink that value. Right? Either way, you're making money, right? When you sell it. Okay, so, and the same with stock. If you think about if you inherit stock, you're going to take the stock value at the date of death, $30 a share. But 6 months later, if it's worth $35 a share, you're better off taking the $35 a share as well. All right, so that way when you sell it, you pay less on the gain. So that's what the alternate valuation date is. Now, in a lot of ways, is it that drastic? Not necessarily, but our stock market's kind of crazy, so it depends on what stock it is, right? Or our property market's kind of crazy right now too, so it just depends on what it is. All right, and then the other one when you're determining adjusted basis is when you convert business property from personal use to business use. So there you kind of got a couple other things that you got going on, like how much was it used for personal? Did you use any of it for business? What was your basis for personal? How are you going to use it for business? So the basis depends on whether the property has appreciated or declined since you bought it. All right. And so then you got, if it's appreciated, meaning it's gone up in value since we bought it, then we're going to use our basis. So what did I buy it at? Okay, well, let's say we're going to use a building that used to be our house, okay, and it's now going to be our place of business. I don't even know what our business is, but we're turning our house into our place of business. So the house has gone up in value, so what we're going to use as our basis is now going to be what we bought that house at, our basis of that house. All right. Now, if it's declined in value, then we're going to use the fair market value, meaning we're going to take the value that it is now versus our basis. So in the end, the adjusted basis for determining the gain or loss on an asset is going to be the initial basis, whatever it is when we bought it, minus any cost recovery allowed. What is cost recovery? For the most part, when I'm talking about an item, what are we talking about cost recovery? We're talking about property. We're talking about, what is it? Okay, now that's adding to it. What would be something that, if we were doing our taxes every year, would be taking, that we'd be benefiting for? So if I use, every year, if I use my house for work, what am I taking advantage of on my taxes? If I use my car for work every year on my taxes, what am I taking advantage of on my taxes for that car? A deduction. And how do I calculate that deduction? I use, I depreciate the car. I depreciate the house. Okay, so when we're looking at that, let's take a look. Okay, Scrap Happy owns a company. They have a computer which was purchased 2 years ago. They're going to call it a 5-year Mackers recovery period. They purchased it 2 years ago for $1,200. For financial statement purposes, they're depreciating it over 3 years using the half-year convention and straight line with no salvage value. What is the adjusted book and tax basis for the computer after 2 years? Okay, so if we just use straight line, assuming that in the first year we only put it into use halfway through the year, what is my depreciation in year 1 and year 2? Okay, go back to financial accounting, even though technically you didn't have to have it. How do we depreciate a $1,200 piece of equipment over 5 years using straight line if we only put it into use half of the time in the first year and a full year in the second year?
of the years.
Okay. So a $1,200 piece of equipment, oh, I'm sorry, it's depreciated over 3 years. Depreciated over 3 years would be $400 a year, but in the first year we only did half of it,
So 600.
200.
Plus 400.
No, right, 200 the first year and 400 the second year, right. All right, so that's using straight line. We'd have 200 in year 1 and 400 in year 2. All right, so now using Mackers, we would have to go to the 5-year table and look at the percentage for year 1 and look at 20%, exactly, and the percentage for year 2, 33%. So 1,200 times 20% and 1,200 times 33. So that was our adjusted basis, 600, and our adjusted basis for tax is 576. So it's not just what we bought the equipment for, we have to take away what we've benefited from. Our adjusted basis has gone down because we've taken a tax benefit from, or benefit from using it. So if we look at now our gain, that is the amount realized, all right, minus the adjusted basis. What did we realize minus our adjusted basis? So our adjusted basis in Scrap Happy was how much? Let's use the tax basis, 576. So we got to figure out what did we realize. So the question's going to be, Scrap Happy sells the computer in the previous example for $400. Our adjusted basis was 576, so we actually have a loss of $176. Now, if you're carrying that computer at $1,200 and you sell it for $400, in our heads, we gained $400. But on the books, we lost $176. Because if we sold it in what year we're in? At the end of year 2, technically, we should have still gotten 3 more years out of that computer, and we only got $400 for it. We should have gotten more money out of that computer, is basically what they're saying. And that's kind of how you look at your car. That's really the only thing we have that we personally kind of look at that, right? We buy a car, and if you go to Kelley Blue Book, you can kind of see how much your car should be worth over a 5-year span. Now, I know a lot of times people now take their car out a little farther than the 4 or 5 year loans that we used to kind of be standard with, so that kind of throws a curve into it. But assuming you have the standard 4 or 5 year loan, you can see that after 5 years, your car should be worth $3,000 and you have it paid off. So you're now ahead of the game, right? My car has been paid off for a long time because it's a really old car, all right? And there's reason, that's because I have kids driving, right? There's no sense buying a new car when you have kids driving your car. But it's still technically worth anywhere between $1,500 and $2,500 depending on what day you look it up, right? So I have value in my car, right? My adjusted basis in my car technically is somewhere between $1,500 and $2,000. If I sold it right now, I'm making money. That's the way I look at it, right? The car is over, it's 9 years old, and I'm making money if I sell that car, so I've done good. Though, technically I'm losing money because then I got to buy a new car and have a 16-year-old drive that, so I'm losing money, I guess. So there's 3 formulas that we've learned over the last couple slides. We got gain realized is the amount realized minus the adjusted basis. And it's gain or loss, obviously, because we just showed the loss, all right? So the big thing there is we have to know the 2 numbers. What's your amount realized and what's your adjusted basis? And honestly, those are the 2 numbers that if you try just to jump to your gain or loss realized, you sometimes get it wrong because you try to jump ahead and not figure out those 2 numbers. So amount realized, cash received plus any fair market value of anything else you got, plus the buyer's assumption of any liabilities, doesn't happen a lot, minus the seller's expenses. So really it's these 2. How much cash did you get, or the fair market value of the property. Sometimes you're given cash and property. Like you're given a car plus cash minus any expenses or something like that. And then your adjusted basis is the initial basis minus any of that depreciation. You got to remember to take that cost recovery into account. Okay, so here's just a little example. This is in your book. This Tetons asset, this is actually from chapter 10. They just go through and notice when you were going through this, they have five different things: machinery, land, office equipment. They go through what they have as the amount realized, and then they have your initial basic initial basic and your accumulated depreciation. That comes to your adjusted basic. So they have both those numbers there. And then when you go through, you will then take your gain. To figure that out, you'll take 1 minus 4. So then it's that amount realized minus your adjusted basic. So you have to, that number that I told you about was your basis minus your cost recovery. And so in the end, this company had a realized gain of $205,000. All right, so now what happens when we dispose of something? All right, a gain or loss that increases our taxable income. So it depends on what we're doing. Taxpayers must immediately recognize most of our gains and losses. We might be able to permanently not recognize or exclude some gains. Maybe, depends on what they are. So a short-term gain, which is less than a year, if it's we're talking property and all this, okay, in trade or business, a short-term period is going to be ordinary. Okay. If it's an investment, it's going to be short-term capital. And if it's an inventory or accounts receivable, it's going to be ordinary. So most things under a year are going to be ordinary, with the exception of personal use assets, and then they're going to be short-term capital. That's not very common from the standpoint of what we're looking at. When we're looking at long-term, more than a year, if it's going to be trade or business, it's going to be Section 1231. Things that are in the trade or business long-term are going to be Section 1231. Investment or personal use assets, what we're looking at a lot of times, that's going to be long-term capital. And that's going to be the reduction in the tax rate that we benefit from holding it long-term. And then inventory, accounts receivable are going to be ordinary. So it doesn't matter if it's short-term or long-term for inventory or accounts receivable, it's always ordinary, whether you sell at a loss or short-term or long-term. So what are ordinary assets? Assets created in taxpayers' trade or business, assets held for less than a year, accounts receivable, inventory, we already said that. And we already kind of said that an asset at a gain, they realize it's ordinary gain, it's taxed at ordinary rates. Capital assets are held for more than a year. And both individuals and corporate always prefer capital compared to ordinary income because you're going to get capital tax rates, which are also always preferred. And then this sums it up for a review of capital gains. Now, corporations we don't look at, but it's just summed up here for you to see. All right, so individuals, net capital gains on assets for more than a year are taxed at 50%. However, this is what we see. 0% to the extent that the gain would have been taxed at 15% or lower if it were ordinary income, and 20% to the tax that it would have been taxed at 39%. So basically, the majority of the tax returns going through on net capital gains are going to be taxed at 15% or lower. And most of the tax returns I see, the capital gains are going to be taxed at 0%, which is what people want to see. So it just depends on where they fall on the original tax rate. So 0% to the extent that they would have been taxed at 15%, and if it were ordinary income, and 20% if it would have been taxed at the highest tax rate. So no matter which tax bracket you're in, you're going to see a significant tax break by having capital gains. All right, uncaptured 1250 on real property held more than a year are maximum 25%. And net gains held more than a year are maximum 28%. All right, those are big differences. Corporations, no preferential rates. Now, individuals on losses, we are allowed to take a maximum of $3,000 a year, but we can roll those forward. And they can keep going and going and going and going. I had someone that had a $36,000 loss in 1 year. And it's just a normal, everyday person, not somebody with a lot of money, all right? And he just keeps rolling it forward because he's also had additional losses. It's not like he just had $36,000 in 1 year and can roll 12,000. I mean, roll it 12 years forward. He's had other years where he's had some gains, so then that money helps offset those gains, and he's used up more than 3,000. But then he's had other years where he's had more losses, and he adds to it. So losses aren't always a bad thing. Remember how we talked about that? Losses can offset your gains, and so that keeps you from being taxed. Losses can be carried forward, but they cannot go backwards. Okay, so here's a couple of our wonderful little assets. All right, so the first one is Section 1231. And 1231 are usually long-term. 1231 are used in the trade or business, and usually, my little sticky note I was going to write up here, long-term capital gains